When I look at the schedule today, I think I can kind of divide the companies up into two parts. One is the steady Eddie growers of production cash flow, and then there are really a couple big catalyst stories. And today, those would be Renaissance, Valoura with the Yamlik 1 test, and Yangara. And Jim's on this afternoon. Our next speaker is more the steady Eddie, and I've called this company the absolute single best defensive oil stock in the portfolio. We're talking about Freehold royalties. They've got a great business model. They've got a low valuation, and this is the type of company that just continues to build steady wealth without me having to look at the screen. So I love that idea. The less time I've got to spend looking at the screen, the better, so I can kind of research other ideas. So we're grateful today to have Tom Mullane with us. CEO, Tom, please come on up and give us the full update on the story. Here's your clicker.
Well, thank you very much, Keith, for inviting us here to talk about the Freehold story. It's been around for 21 years. It's not something that's been around. It's been around a long time, so it's not a fresh story. However, it has got a lot of visibility since Prairie Sky came to the market about 4 years ago. But we continue to be a good generator of cash, and we're a safe way to play the oil and gas space. And we'll go over some of our metrics on how we frame our story and how we can have delivered value for many years and how we'll continue to do so. So when we look at some of our, I call this tourist information, we're about 12,000 barrels a day. 99% of our operating income comes from royalties. We have become a pure play royalty company over the last 5 years. 5 years ago, 30% of our production came from working interest production, and we drilled our own wells. We had a capital budget of $40 million. That's all gone away. We are a royalty company. Our capital budget, which is is extremely small, and so we are a pure play royalty company. We have a dividend of 63 cents a share per year. We've increased our dividends the last couple of years as the oil patch has I guess recuperated from the big fall in oil prices in 2014 and 15. Most of our revenue comes from oil and natural gas liquids, 88%, and so we're very tied to oil prices and to WTI price. Our current dividend yield is 5%, and it's a very safe dividend as we pay at only 60% of our adjusted payout. Our market cap's $1.5 billion, and our net debt to funds from operations is 0.7, and that will be about 0.3 at the end of the year if we don't do any acquisitions over and above our free cash flow. Oh, if we don't do any more acquisitions. We have done a lot of acquisitions in the last number of years. We'll get into that. So there's three ways to create, we deliver value to our shareholders. We create value by buying acquisitions, and we've been doing that over the last number of years. We also lease out our lands. One of the things that was a little confusing to producers when we were drilling on our own lands and leasing out is the question on the producers was, are you saving the best lands for yourself? And we couldn't really actually say that we weren't. So we don't drill on our own lands anymore, and we don't have a capital program to drill. We haven't done that for 2 or 3 years now. And so it's very clear to producers that we're open for business, and we'll get into the number of new leases that we've had created with producers, but we've increased that threefold over 2016, and in a great, we've created a lot of value through new leases, and we're on our way in 2018 to have another great year of new leases with producers. We enhance value through our audit program. We just make sure we get paid what we should get paid. That has generated $69 million of value to our shareholders over our 21 years. So that audit program is good. When we buy a lot of assets through the history, some of these contracts are a little complicated and some guys aren't paying us the full share, and our auditors just make sure we just get our fair price and our fair take. And we enhance value by just keeping our debt really low. We'll show that as well. So we have a low payout and low debt, so we position ourselves as a safe way to play oil and gas. And we deliver value through our dividends and improving the quality of our assets, which we've done over many years here. When you look at our investment performance over the last 21 years, it has been quite impressive. Obviously, it's been challenged, just like the rest of the oil patch in the last 4 years. However, things are turning around, being weighted to oil. Things are starting to pick up, and we're doing quite well, and our metrics show that. If you had invested $10 in our shares at the IPO, and you reinvested those dividends, it'd be worth $122 million today. So as an average 12% return to shareholders over our history. When we look at what we've done over the last 4 years, one of the things we've done is we've increased our royalty production by about 63–65%. We've doubled our land acreage, and that's where the future comes from. When you look at, we've gone from 3 million acres of land to 6 million. So that's where the future is. And also we've doubled our tax pools. We don't see ourselves taxable for about 3 to 4 years, depending on oil price, which was, when I started 6 years ago, was our number one cash expense, was the tax we paid. We don't see that. And our tax pools have increased and our debt has gone down, and we are at 1 times or less than 1 times. Our target is to be between 0.5 and 1.5, but our happy space is around 1 or less. We pay about 3.3% on that debt, so it's actually it's quite accretive to have some debt. But we want to position ourselves as a safe investment, so we keep our debt down in case interest rates rise. And acquisitions, we've participated in buying acquisitions through the downturn. What we've seen with royalties is that when prices are high, we see more drilling on our lands, and when prices are low, producers are looking to divest of non-core assets, which could be royalties. And so we're able to pick up good quality assets in the downturn, in which we did. When you look at our monthly free cash flow, our dividend yield is 5%, but our free cash flow increases with oil price. And so today, I think the average WTI on the strip for the balance of the year is about $66 a barrel. Next year, $63. And so when you look at our free cash flow, our dividend at 5 cents and a quarter per month is really well protected down to like the 40s. So you can be rest assured that our dividend is safe where it is, and you need a huge correction in oil. I'm not going to say it's never going to happen again, because it happened in 2016 and it was pretty painful, but we are protected on the downside just because of our ability to pay our dividend at very low oil prices. Even at the depths of despair, when oil was about $28, we still had a 4 cents per share dividend, which was fundable and well protected at that point. When we look at our operating margins, they're very high. As a royalty company, we do not pay operating costs. We do not participate in the drilling of wells in our lands. We don't pay royalties, and so our margins are very high. We had a cash cost a couple years ago when we still had some working interest assets. Our total cash costs were in that $7 to $8 a barrel range. There were projected to be $5 a barrel range, and as we are more levered to oil, our netbacks are in that 35 plus range a barrel, which are very good compared to E&P companies. Our dividend is sustainable, as I mentioned, and here's just where we were going in 16. Our payout ratio is quite high. We did drop our dividend, but we've increased our dividend the last 2 years, and we increased it 25% in 2017, and this year we increased it by 5%. And we are right on the lower end of our adjusted payout target. We are going to continue to watch where WTI goes in the next few quarters, and then we talk to our board about our dividend and have a potential increase if prices stay in this mid-60s range, but that's something we discuss with the board quarterly, but we have increased our dividend over the last 2 years in the beginning of the year. And our net debt to funds from operations is low, and will be at 0.3 times if we don't do any acquisitions. However, there is a strong acquisition market. We've done about $34 million of acquisitions this year. We did about 83 to 86 last year. And so we continue to participate in adding quality royalty assets to our portfolio. And a lot of this is done with free cash flow. We did $86 million worth of deals last year, but we didn't have a raise or anything like that. So we haven't had a raise since early 2016, and we continue to add assets within our own funds. When you look at the drilling on our lands, 60% of the drilling is either in southeast Saskatchewan or in Saskatchewan or in the Viking play. Our top 5 plays are in Saskatchewan, which is a very, very friendly environment to drill and have very good netbacks because they're all light oil generally, drilling in those areas. So that continues to see funding, and with these increasing oil prices, and if they remain, we believe we might have a record year of drilling on our lands this year. And here is the drilling trends. On a gross basis, the drilling was up in the first quarter. On a net basis, it was down a little bit. We think there was a little bit of a pause in some on our mineral title lands, but we think that'll pick up. With our leasing activity increasing dramatically, that usually leads to drilling on our lands because they don't lease. These are short-term leases, 2 to 3 years. They're not going to take a lease out if they're not going to drill it, typically. Typically, it's drilled. But we are forecasting a 25 net wells. That's the gross number of wells multiplied by the average royalty rate. One of the things that we will find as a business, we have 300 payers. They're all quality names that pay us. We've had very few defaults, very minimal as far as our, even in 2016-17 when things were really going bad, we had very few defaults. So we are well protected as well as the way we structure our royalties. We have the ability to take in kind. And so it means that we're safe, and we spend a lot of time to make sure that we can, if a producer is in trouble, very few of those now are in trouble now that the oil prices are come up and a lot of balance sheets are fixed. But we do protect ourselves, and we do take about 15% of our production in kind and market it ourselves. We don't believe we have to take that much, but we're just overly conservative in that. The new leases with producers, you look back in 2016, we did 30 leases with producers, and we tripled that last year, and we're well on our way to increasing the number of new leases, where we have close to 50 today. So we're halfway there on last year's performance. We created a new leasing team at the beginning of 17, and they're doing a fantastic job of getting our lands out to producers and getting them marketed and getting them drilled. So what is our near-term focus? Well, we always want to enhance our royalties by buying acquisitions that are better quality than the assets that we have right now. We did a few acquisitions this year where we added some royalties on the Weyburn field. I think most people are familiar with that. A field I think it was discovered in the late 50s, unitized in the early 60s on water flood and then on CO2 flood. It has a a 75-year life ahead of it. We bought a royalty on Mitsu Gilwood Unit Number 1, which is a very flat, relatively low decline asset as well in the first quarter. We also bought a little bit of an interest in some Duvernay lands, a 1% royalty on on some in the Huxley area. And so we are adding to our positions and adding quality assets that are gaining attractive economics. Some of the producers in that area where we just gained that the royalty in the Duvernay, they just did recent funding was completed this week actually. So we're going to see more wells drilled there. We want to grow our dividend, but safely, and we revisit that every quarter with our board. We want to remain a low risk, so we're going to keep our debt down, and we're going to keep our payout down as well. And we're just going to continue to organically grow through these lease outs and getting our lands out to producers. In April, we came out with our asset book, and that was detailing the depth of inventory we have in our lands. We hadn't outlined that to investors. We had a 10-year inventory that we put together over a month or so in 2016. But we took over a year, reviewed our lands. We have reviewed our 6 million acres of lands. What we did was identified over about $7 billion of undiscounted value on our lands and 21,000 wells that could be drilled on our lands. We think that this was a piece that was missing in our story, is that we have a 40-year drilling inventory on our lands, and so we're going to be in the royalty business in oil and gas for a very long time, and it's a very safe investment. When we cut up the Western Canada into 5 areas. 80% of the value of the future locations are in Saskatchewan and in central Alberta. And most of this are oil targets. We have an oil-weighted asset base. We have a diversified portfolio. We have 21,000 locations on our lands, 40 years of future development at current drilling pace, and it was a $7 billion undiscounted total value. We have the asset book is on our website, as well as the presentation that we gave in April. A little over a month and a half ago in Toronto. That's on our website as well. So take a look. I think there's a lot of valuable information there. So why would you own Freehold? We're positioning ourselves as a safe way to play the oil and gas space. We've outperformed the TSX index and the oil and gas index over our history. And I think it's because as a royalty company, your top line, so you don't have those inflationary pressures on drilling and op costs that you have when you're a producer. We just take the top line, and that has served us well over the 21 years. We're sustainable with a very low payout, low debt, low cash costs. We also have a strong balance sheet, and we have quality assets with greater than 40 years of drilling inventory in front of us. So this is a company that has been around for 21 years. We've been delivering value to our shareholders over that time period, and I think we can continue to do that for another 20 plus years at least. So if there's any questions? Yes?
What does your deal pipeline look like today with higher oil prices, and how does it compare to a year ago?
Okay, the question was, what's the deal pipeline look like? As oil prices increase, I'm always worried that the producers don't need any money anymore. They'll just live within cash flow, or they'll equity raise. One of the things that we're finding is that it's only a very select few that can raise money, raise equity right now. And so producers are still looking to increase their drilling programs, and they're still looking in their their cupboards for royalties or creating royalties to fund that development. So we haven't seen the pipeline actually decrease. Paramount has a package that bids were due today on. There's a number of, we work on about 3 to 5 different royalty packages at any one time. We always worry that that's going to fall off. We haven't seen that fall off in the 4 years I've been, or the last 4 years or the last 6 years when I've been involved in the company. The first couple of years were kind of slow, but in the last, since the oil downturn, it hasn't turned off. And until there's a increase in access to equity, we still think there's going to be a good pipeline flow.
What are you paying for your royalty units on a multiple?
The question was, what are we paying for our royalty units on a multiple? And the royalty units,
Cash flow,
when we buy assets.
yeah, what's your typical, do you have a typical?
So I'll just describe how we go about assessing value on royalties. And so that'll make a it's like working interest assets. Some are worth 1 times cash flow and some are worth 10 times cash flow. Royalty assets are very similar. Some are worth 3 times cash flow, some are worth 25 times cash flow. So the process in evaluating a royalty asset is that we take the existing production, royalty production, blow it down, put a decline curve, a discounted cash flow model to get together on that. We add a drilling wedge on upside. If there's a lot of upside on a lands, then the multiple is very high. But our geologist looks at historical drilling and what we see as future drilling based on current commodity prices. And then we add some land value to that. We put in a cash flow deck and we pay, depending on the quality of the asset, either high single digits or low double digits, or we don't bid at all if it doesn't improve the quality of our assets. So on a multiple basis, it could be as low, we actually don't bid on much at a very low multiple. Because it's a low multiple, usually it's not a quality asset, and so we don't bid on those. But on quality assets, oil sands assets could be 20 times. On a deep inventory gas asset, it could be in those kind of multiples just because gas prices are so low right now. We haven't been able to do a lot of gas deals just because the bid-ask spread is very large. But it varies, but it's most of them on a rate of return driven, not a cash flow multiple driven kind of evaluation.
In this
Yes.
format, who's responsible for the well abandonment situation as wells get abandoned over time? Is it your producer customers, producer associates?
Think of us as the Crown Corporation, or think of us as a farmer who owns freehold title. We have no obligations for abandoning wells as a royalty owner.
Tom, how do you differentiate yourself from Prairie Sky?
I never get that question. No, thank you. The question is, how do we differentiate ourselves from Prairie Sky? I think Prairie Sky is a different land base than we do. Theirs is more concentrated in central Alberta and along from the historical lands that they have. They have about 15 million acres of land. We have 6 million, but on a per share basis, we're very similar, about that 50 to 55,000 acres per million shares or something like that. And so our land base on a per share basis is very similar. Our cash flow per share we actually had a better last quarter than they did. So the opportunities on our lands on a per acre basis actually higher, just because we are in areas where it has, specifically southeast Saskatchewan, we have a bigger presence there, where it's medium or light oil. There's multiple zones, multiple targets there. That differentiates ourselves. We have a very strong position in the Viking and the Dodsland area. It's in Saskatchewan. I think the best quality historical Viking is there. So we have very good positions there. They have a very enviable Duvernay position. They have 1,000 sections, and we're building our position in the Duvernay. They have some very good lands, but I think in general, we love our lands. We think there's lots of opportunity, as we outlined in our asset book, and on a value play, this is a much better buy.
Tom, let me ask you one question here. A year ago, the street was giving you pushback that they wanted to see less working interest production, more pure play royalty, less debt. And so you're able to look after all the street's concerns in the last year by selling your working interest
Well, that's a very good question, Keith. What we want to do is continue to do our business, and what we'd like to do is have more organic growth in our land and show growth on a per-share basis. And I think it's very challenging for both Prairie Sky and ourselves to do that over the last 4 years on a per-share basis, just because of the industry where it was and the amount of drilling that was being done on our lands. What we have to do is just continue to show on a growth, a cash flow per share, production per share growth. And we can do that organically without any costs, without raising any shares, et cetera, by organic drilling on our land. And that's by leasing on our land and getting producers to drill on our land. We are showing an uptick in our leasing, and eventually that'll turn into drilling and higher drilling rates. We hope we have a record year of drilling on our lands, but we think we just need to perform quarter over quarter. I think that's what the shareholders want us to do.
This difference you say between the gas producers and yourselves in the bid-ask spread on gas assets, certainly that would be a great countercyclical play over the next year and a half. Is there any color you can kind of say, give on that dynamic, or they just kind of go, gas is going to be low forever and blah, blah, blah. You obviously have to price in. There's a real possibility it will be. Well, any color you can give on that dynamic?
So our objective is to get assets which have a deep inventory of drilling on the lands. There are plays in the Western Canada that will continue to grow. We believe the Montney will continue to grow and oil sands will continue to grow. Conventional assets, it's very selective where it's going to have growth. We'd like to do a Montney deal or a Deep Basin deal that has a strong inventory, and so that you don't pay too much for it today, but a reasonable fair value, but something that can continue to grow into the future. So we would look at deep inventory kind of gas plays that have some liquids so they're survivable, and also look at some resource plays like oil sands as well.
No other questions? Okay.
Well, thank you very much, everybody.